of software in your course?
Yes, sir.
Okay. So if it is you are aware with R, so it is trust will be easy for me. And my discussion thing is that is financial econometrics with the help of R. So before going and directly enter into my topic, and before going to that, I have some presentation, and I mute my actually my video is muted. So I'll directly go to the presentation.
সরি স্যার, ফোনটা স্যার খোলা রাখবেন।
হ্যাঁ হ্যাঁ, ফোন খোলা আছে, ফোন খোলা আছে।
ঠিক আছে,
আগের বারের এক্সপেরিয়েন্স। The screen is visible to all, and am I audible to all? It is clear, my voice is clear?
Yes, sir.
Yes, sir.
Okay, okay.
Yes, sir.
So the thing is that the financial economics and basically the financial econometrics, that is application of econometrics in financial, dealing with the financial data. And literal meaning of econometrics, I think everyone is from the background of economics, so it is something like measurement in economics. So, or correctly, it is the econometrics is rooted in the origins of economics. So the main technique employed for studying economic problems are equal importance in financial applications also. So financial econometrics will be defined as the application of statistical techniques to problems in finance. So financial econometrics is useful for testing theories in finance, that is determining stock prices or returns, testing hypotheses concerning the relations between the variables, examining the effects of financial markets of change in economic conditions, that is forecasting of futures for different financial value variables, and also the financial decision making. So these are the parts. These are the parts I'm trying to touch. So I'll start from very basic ideas, that is how to calculate the returns, this kind of things, how to calculate the portfolio's returns and the risks, this kind of things with the financial R software. Okay, so financial data first, it is differ from macroeconomic data in terms of three basic things, that is the frequency, accuracy, and seasonality. So macroeconomic data and financial data, there are some differences. So in economics, basically in economics, and those who are like us who are dealing with the data, that is a serious problem is lack of data in our hand for testing of the theory. So in macroeconomics, if you want to do some work, a huge number of data is required, a large number of data is required. So for any kind of macroeconomic problem, majorly, and there is something like small samples problems, this kind of things. So data are required on government budget deficit, for example, or suppose on population figures, which are measured on annual basis. But suppose you are doing some project on population studies, on demographies, or on GDPs, this kind of over the year. So if the methods used to measure these quantities changed a quarter, then only most of the observations are only a few observations are usefully available. So two other problems are often encountered during such econometric work, that is the measurement error and the data revisions. This difficulty is simply that the data may be estimated or measured with error. That means there are some error, and several vintages of subsequent revisions are there. So for example, you may assume that a researcher may estimate an economic model of the effect of national output of investment in computer technology using a suitable published data. Suppose a published data is there. So only to find the data for the last 2 years have been revised substantially in the next updated publication. This is the problem. These issues are usually we face in finance. So financial data comes to us in many shapes, in forms, in different forms. And for example, generally the prices of the stocks and other entities that are recorded, those are traded. So actually took place, but suppose we have to convert the data in terms of like, we are not dealing with the prices, we are dealing with the returns. So you have to make some conversion. So there exist, of course, the possibilities of types or for the data measurement method to change these kinds of things. That means formulations. So in general, measurement error and revision problems are far less serious. It is more serious in macroeconomics, but less serious in financial countries. So this is the way, that is the financial data and the macroeconomic data are different. And second thing is that financial data are observed at much higher frequencies than the macroeconomic. For example, the share prices or the stock asset prices. It is available in daily, hourly, minute by minute frequencies. So the number of observations which are available for our analysis may be very large, perhaps suppose for thousands or even millions, and making financial data something that is envious to us macroeconomicians. So because such availability makes their envy. So the implications is more powerful technique and can often apply to the financial than any other economic data. And researchers also get more confidence in this result. So financial data also brings with a number of new problems, while the difficulties also there. So difficulties is like for example, that is that kind of, that's suppose a noise is there. That means it is more difficult to separate the trend patterns or these kind of things. These difficulties are there. Obviously, that is in macroeconomics and also in financial economics. So financial data are almost always not normally distributed. Specifically, during the COVID, you find that the data is not normally distributed, and it is happening to us. That is, we are getting data which are not. But in generation of our knowledge, in case of generation of our knowledge, we always assume that it is not, and from there we deviate. So high frequency data often contain additional patterns, like suppose beta, gamma, these kind of distributions, or the way that is how the data are maintained. For example, how the prices are recorded. These factors will influence. So these features need to be considered in case of model building process when you are considering your research work. So one of the most important thing is that there is a market microstructure. And market microstructure, where we are doing this kind of things, that is cleaning, managing, or these kind of things of our database. So it is evident that market microstructure effects are important because it represents the difference between financial and other types of data. So these types also exist in finance. For example, market rigidities or frictions can imply that current asset prices do not fully reflect the future cash flows. But what is important for us in case of studying financial econometrics, that is we always try to predict the future, or we always try to explain the present. That is, what is the nature of the behavior? What economic factors are influencing? If this is the economic condition, what will happen in the stock market? What will happen in the land market? What will happen in the credit market? This kind of situation. So investors are likely to require compensation for holding securities that are illiquid. And then when he entered into the financial market, they embody some risk. And that is related with some probability-based concepts. So this is our starting point. So regarding R, you are aware that it is we applied here R 4.0.5 version. Those who are familiar with R, it is no problem to them. They can you can download also from the CRAN project, R CRAN projects, and the software is completely free. And what are the advantages? I just shortly explain that what is the advantage and disadvantages of R. That is first thing, what you call advantage, that may be a disadvantage to someone, because for me, because so much command is there. So without command, you cannot do anything. So it is a command-based software, and commands are freely available. Do not. That is my request to you, that when I am using these commands are given in this screen, and you do not concentrate on the commands, because I will supply this presentation to the Shankar Babu, and you will get it easily, and you can practice through those. So our commands is not very important, because why? Because we can get it. If you suppose if you write some command that how to make the divisions in R, then you just go to our blogger and type your problems, and you get the code. This is the way. So don't. But what is the beauty of that? That R is more complete than any other software. Why more complete? For example, I'm just giving you one example. Suppose you are running a regression kinds of problem in SUbhasis or in eViews. So what they gives us, that is partial results. Why we call partials? Because, for example, they derive the RSS. That is residual sum of square. But you are interested to find out what is the value of that is sigma u hat square. So that is not problem in R, because R derived each and every kinds of results. That is the beauty of R also. And for example, to estimate the derive, for example, to plotting of the data, that is derivation of figure, those are more beautiful in case of R. So if I share the R screen to you, there are actually four things. There are actually four things in R. 1 minute, just this part is called the source. This part is the source. Here all programs and files and data source which are imported or downloaded are stored. And this part, that means they actually it is divided in four parts. It's divided in four parts. And this part, first part is the source, and the second part is the console, where we write the R command. That is here. Actually, we write the R command. And this is the environment part. This is the environment part. That is here the different functions like import data, history, communication, connections, tutorial, these kind of things are there. And here this is the output part of the R, that is the plotting area. So these four things are there. So you write the command here before after that is installation of the packages or these kind of things. You just write the command, and you get the results, either the numerical results shown in, this is also the output platform. Here the numerical results is also there, and the plottings are also here. So this is the main four things of R. And I'm not going to share those kind of things, that how to import data, these kind of things, because we are doing this because basic aim of this, how to operate the financial kinds of financial economic kind of things. So I'm started with very simple problem, that is calculation of the future value. And we know, suppose R amount of V amount of money, with R is the rate of interest. And if it is going for n years, then what will be the value? The value is defined by this way. That is V into 1 plus R to the power n. That is, consider the amount V invested for n years at a simple interest rate, R per annum. That is, R is a decimal here. And we compute these things. So, for example, I'm just showing you an example, that is putting rupees 1,000 in an interest checking account that pays the simple annual percentage rate 3%, the future value after suppose 1 year, 5 years, and 10 years, and I calculate these future values. These values are shown here. That is 1030, 1159.27, 1343.92, and the R code that is over the first year, the 30 is the interest rate is accurate, and over the 3 years 159.27 is the interest rate, and over 5 years 343.92 is the interest rate. So how to write the R code? That is this V is 1000 according to this formula. So if I copy this, and then R is 0.03, that is 3%. And then I calculate the first year. After, what is the value after first year? What is the value after fifth year? And what is the value of the after 10th year? And then classify all these results. So these are the values, these are the outputs showing that is 1030, 1159.274, and 1343. So these are the way that is how R is working. These are very numerical, very easy numerical problems. So what is important thing is that I just telling to you that is in this form, that is Fbn is equal to V into 1 plus R to the power n. There are 4 things. That is, one is future value, another is initial value, and another is R, another is N. So given 3 variables, the 4 variables can be easily determined from this equation. So if the other 3's are given, we can determine the value of V. If the other things are given, we can determine the value of R. These are simple mathematical deductions from this one. So given this F, B, and R, we can solve the values of N also, taking the log. So these are the way that is annual rate of interest are how defined. So sometimes there are some problems like how many times it will take to become say money double. That is FBN becomes 2V. This is called in financial, this is called rule of 70. And this we use the same thing, that is how much time it will take. That means FBN is 2V. So if we put here 2V, then it becomes log 2, that is 0.6931 value, that is almost approximately to 7, and this is log R. And if I consider that R is very small, so log of 1 plus R is equivalent to R, then the rule becomes just 0.7 by R. And using R, that is by this technique, so if you put the coding, that means you find that if R is 1%, then exact calculation, exact means this one, exact means this one, that is this value, that is log 2 by log of 1 plus R. That value is 69.66 this kind, and if I apply this form, that is 0.7 by R, these two values are approximately close to each other, it becomes 70. If R is 2%, then it is 35, then it is 35. If R is 3%, these are the values for the different values of R. So what is the code? The code is that we consider here, look at this coding, that is we consider the sequence, that is starting from 0.1 That is, the rate of interest started from 0.1 and ended with 0.1, that means 10%. And what is the gap? That is, gap is 0.01. That means first 0.01, then 0.02, then this. Then I write the n exact is the form of the formula. That is what is the exact things. That is log 2 by log of 1 plus r. And what is the rule 70? We write it as, this is the rule 70. That is, we write it as n rule 70. That is 0.7 by r. Then I combine this results and I obtain the thing. So this is the thing. How we get the rule of 70. So suppose I'm just getting one by one, because these things, without knowing these kind of things, it is not possible for us to know the financial kind, that is return calculation of this kind of things. So this is suppose consider the periodic interest. That is, if the interest rate is paid in m times per year, then what is the future value after n years? And it is a simple arithmetic formula, and you know this is the value. That is v into 1 plus r by m to the power n into n. So this calculation, estimation can be done by two ways. One is called that is simple compounded. And if this m terms, that is how many that is the interest rate paid in what interval, that interval, if it is estimated in terms of the continuously compounded, these two are very important in case of this return calculation or this kind of things. That is whether it is the interest rate is simple compounded or continuous compounded. Then instead of this one, we use this one. That is this formula. That actually y comes because if m is continuous, that means m changes continuously. We use the limiting sense, and this value is going towards exponential series. So v into e to the power r into m. So this is the calculation of future value. That is, if the interest rate is compounded in terms of n years. So, for example, suppose I am giving you one problem, that is annual percentage 10%, the value of 1,000 at the end of 1 year. That is 10% value is that is how we put the initial wealth 1,000. We put the initial wealth 1,000, and the rate is 10%. And we consider here the frequency as 1 times in a year, that is biannual, quarterly, daily, and also 1,000 times, 10,000 times. So we consider the frequencies by these values. And we calculate this thing, that is a simple compounded. These are the values. These are the values. That is the future values. On the basis of first, that is annually, it becomes 1,100, and if it is biannual, it becomes 1,102.5, and if it is quarterly, then it is 1103.813. If it is daily, 1105.155. If it is 10,000 times, then it becomes 1105.170. So we can estimate this also in case of continuously compounded. So then we just write the formula. So look, that is I here only the value of 10,000 times. So it is 1105.171. So this is the case of the continuous. So why I am taking the 10,000? Otherwise, look, the values these are the discrete case. This is the continuous. So this is the difference. No difference is there. That is continuously compounded. If it is, so look here. That is these things. That is the estimation of. I'm telling earlier. That is this estimation of if there are the 4 things. So if 3 are known to us, we can estimate any one. So these formulas, these things actually consider the case of simple compound interest. But if it is continuous compound interest, the formula changes because that becomes e to the power things. I will discuss it in later if time possible. Otherwise, so now the concept is what is effective annual rate. This you know everyone. That is the relationship between simple interest rate, periodic rate, effective annual rates, and continuous compound rate. This I will discuss. Suppose the investment pays a periodic interest rate 2% each quarter. Look, 2% each quarter. So that means it is 8% annual. So if 1,000 rupees invested, 8,000 annual, and that is in terms of the 4 quarters. What will the value? The value is 1082.40. Now, if the effective annual rate on the investment is determined from the relationship like this, it becomes 1082.40. That means if I do not consider this one, if I consider that my rate is such that I'm consider the thing at the end of the year what I get, then I use just 10,000 into 1 plus RA, that is equals to this value. So from here, I get the value of R, and that R is 8.24%. But what is the actual rate? That is 2% quarterly, that means 8% annually. This rate, this 8.24% rate, if I do not consider the quarterly return, if I consider it in terms of the yearly return, this return rate becomes 8.24%, which is actually, it was 8% per year. So the effective annual rate is the simple interest rate with annual compounding that gives the same future value that occurs with simple interest rate compounded 4 times per year. So the effective annual rate is greater than the simple annual rate due to some payment of interest on interest. That is why that 8% becomes 8.24%. So this general simple relationship between annual rate R with payment M times per year and the effective annual rate this, and we write the relationship is in this form. We write the relationship, if I consider this relation, that is 1 plus RA is equal to, that means this value is equals to that value. Okay, so the relationship is this, and then from here we can determine the RA, from where actually this 8.24% come. That is from here we determine the RA. Then from here we can solve the value of R also. That means transferring this one and then taking the and that is changing the power or log or this kind of things. It is not log, it's changing the power, and then we can multiply -1, then multiplying by n, we can derive the value of R from here. So this is the simple rate. So this is the relationship. This relationship is very important. Mind this is the effective rate and this is the simple rate. Sorry. So the relationship between effective annual rate and simple rate, that is simple compounded. If it is continuously compounded, then this value that is this 1 plus RA, this becomes e to the power R. This becomes, in case of continuous compound, what do we write? This becomes e to the power R. So that this relationship in case of continuously compounded values becomes 1 plus RA is equal to e to the power R, or you may write RA is equal to e to the power R minus 1, or you may write it just look at this relation. That is, what is R? That is log of e to the power R. So we can determine the R also here. So we can determine the value of R also. So the effective annual rate associated with the investment in our earlier example, that is how it is associated. So we can consider RA. How to find the effective annual rate? these are the values that is earlier derived. That is if the values is becomes that is 1105.170 after 10,000 times, this becomes this that RA becomes this, and the what is RA is there, that is 10.51%, 10.51, or this kind of things. So if it is simply compounded, if it is continuously compounded, what will happen? If it is continuously compounded, look, that is 1,105,1,709, and that is 1,051,704. So this kind of changes are there. That is the effective in between effective rate. So it is 10.51709%. Okay. So this is the way we can define the effective rate and compare it between the simple rate. Now just directly going to the financial economics. So suppose the stocks are there, stocks, bonds. We devise our that is return calculations for future price associated with the investment. We first cover the simple return calculations, which are typically reported in practice but are often not convenient for statistical modeling purposes. Then we describe the continuously compounded return calculations, which is those are more convenient for statistical analysis. And here we consider the purchasing of an asset. For example, assets are like stock, bond, ETF, mutual fund, options. And it is at the time T0, the price is PT0, and selling the asset at the time T1, the price is PT1. So just simply consider this is the thing. And there is no intermediate cash flows. That is, we assume that there is no dividends kinds of things between the period T0 and T1. And the rate of return over the periods, we can consider this, the rate of return, as simply by this form, that is PT1 minus PT0 divided by PT0. So the time between T0 and T1 is called the holding period, and this term, that is PT1 minus PT0 by PT0, is called the holding period return. So in principle, the holding period can be any amount. One that means once again, it may be 5 minutes, it may be 8 hours, 2 days, 6 months, 2 seconds, 15 years. This may be, there is holding period is a time difference, and that may be whatever may be. So to simplify with this matter, we just consider, suppose for example, for the better understanding, that is, it is suppose 1 day or 1 month or 1 year, this kind of things. So PT denote the price at the end of the month T of an asset, and which pays no dividends, and let PT minus 1 denotes the price at the end of the month T minus 1. So 1 month simple return, that is this RT is considered as that is delta PT percent. That is the thing. And we know everywhere we can use these things. So from here, we just estimate this, that is dividing this, that is PT by PT minus 1 and PT minus 1 by PT minus 1, that is 1, that 1 is transferred into that side, and we get this relation, that is 1 plus RT is equal to PT by PT minus 1. That is 1 month gross return. 1 plus RT is what? That is the 1 month gross return has the interpretations of the future value of ₹1, suppose invested in some stocks for 1 month with simple rate of interest, that is RT. So RT, if RT is the interest, then if I invest ₹1, what will be the amount at the end of the month? So from here, simply we just get the PT, that is the PT minus 1 and 1 plus RT. That means this is the first step of predictions. That is, if you know the RT, and if you surely know PT minus 1 because it is past data or historical data, and from here you can guess if it is the future, that is PT. So that is returns means this kind of returns means net return. That means after asset price are always be non-negative. But so the RT values is that is return. It may be negative. Mind this, RT may be negative, but the PT and PT minus 1 is always non-negative. So we consider an example of return, simple example. Suppose the stock of Microsoft is there, and at the price at the time t minus 1, its price is rupees 85 and it is 90. So it is, you can easily calculate this, that is 90 by 85 minus 1, that is 1.1 plus RT is this, that is 1.0588. So that means 1 month investment Microsoft yield that is 5.88% per month return. So through R, we just easily calculate this, that is P0 is 90. So we get the monthly return, that is 5.88%. So it is. I'm making myself quite fast. That is, if it is multi-period returns, that is, for example, 2 periods, then the equation relation becomes this. That is PT minus 2 by PT minus 2. So it can be written by this way. So we can write this way by that is introduction, that is PT by PT minus 2 can be written as PT by PT minus 1 and PT minus 1 by PT minus 2. And earlier we get that is PT by PT minus 1 is nothing but 1 plus RT. So obviously PT minus 1 and by PT minus 2 can be written as 1 plus RT minus 1 minus 1. So from here, this 2 is written because it is considered in 2 periods. So why for notational I write this. So if I transfer this 1 into that side, that becomes RT 2 plus 1 is equal to these two multiplications. And if I multiply these two terms, and this becomes this. And look here, this one cancelled, and the relationship is this. So now one assumption, this is the final relation. Now, if one assumption is that look, if RT is the rate of interest which is very low, and RT minus 1 is also a very low return, that is a very low rate. So this two rate multiplication becomes also close to 0. So we can write this 2 as the sum of these two. That is this. And that means if these rates are very low, then only it is possible for us to write this in this term. So now suppose consider the 2 months investment in Microsoft stock. Suppose you buy the stock at the month T minus 1 price 85 and sell it in the next month at 90. And suppose the price of Microsoft stock in T minus 2 period is 80 and no dividend paid in T and T minus 2. Then it is your RT2 is this, that is 90 minus 80 by 80, and this is 12.50%. And then if you break it in terms of T and T minus 1, and that is T minus 1 and T minus 2, that is 85 minus 80 by this gives us 6.25%. And if you consider between the T and T minus 1, then it is 90, between 90 and 85. Then you get that is 5.88%. So if I added this 2 by considering, since these two rates are very, very low, so we get that and the return becomes 12.13%. But where it is, if I consider the 2 periods, then it becomes 12.5%. So the geometric average, if I consider the geometric average of these two, that means if I multiply these two return, this two rate, that is this one and this one, this becomes 12.50. That means more or less similar. So geometric application, geometric mean is an approximate, why it is an ideal case in statistics. We know under such calculation. So what is the if I want to verify this in R, so then So look, if I consider this earlier two data are there, that is 85 and 90s are there. So I am introducing only the P0, that is the PM2, sorry, 80, and then I consider the PM2, PM1, and P0, these two, and then I get the form, that is I get the 6.25% and 5.88%. Then I consider this, that is 12.50, and if I consider the same calculation using R functions, that means what I'm getting here, that is what is the interesting thing is that is when I consider multi-periods return, when I consider the multi-periods return, this plus 1, if I transfer this 1 in this side, then you just get the returns multiplications, that is 1 plus RT into 1 plus RT minus 1 and 1 plus RT minus 2 and so on. So if there are multi-periods this type, by this way we can estimate the returns. So now we're dealing with some investors post-portfolio. The objective, what is the objective or of the problem of the investor? That is to decide what asset to buy and also for by what amount. And this is known as portfolio. So what is a portfolio? That is on the basis of the objectives, the investor decides that which asset to buy and by what amount. These two are the variables to him. So mind this. So investor is going to select the portfolio of assets. Let here, for example, X is a portfolio, that is suppose he has n number of assets, then like this, that is x1, x2, and xn. And these are the amounts, that is what are the xi, for example. These are the the amount of money invested in ith asset. That means how much money I invested in. Suppose I have 1 lakh of rupees and my portfolio is 1 lakh of rupees. So what amount of money is in particular assets? So remind this. But sometimes we can express in a different way. Assets are purchased at the time 0 with prices of this. That means initially when I purchase the share, these are the prices like P01, P02 and so on. And that create the portfolio, that create this portfolio, that purchase create this portfolio at time 0. So what is my total wealth? Obviously my total wealth is this, that is which is derived from my portfolio. So we can make in terms of some ratio, that is if this is the price of a unit of a share, and if I put this amount of money, then how many shares I actually purchased, this is expressed by HI. So HI is the number of the unit, that is the physical unit of assets I in the portfolio. In which portfolio? In this portfolio, mind this, in this portfolio. So we express the portfolio in terms of such excess, or we may express the portfolio in terms of such HS. You may write the portfolios in the form like this. You may write this in this form, that is instead of X, you may write this in terms of H. In terms of H also. So either you express it in terms of the monetary units or maybe in terms of the physical units. And normally we are dealing with those who are familiar with the share market or this kind of things. They are normally dealing with the physical units rather than monetary units. So suppose for example, we can. I'm not going to that kind of example. Now the question is, the coordinate of xi, that is it possible the coordinate of xi is negative? Yes, this is the thing of finance. That is, suppose I is equal to 1 is an asset, and suppose this is cash. Now suppose I is equal to minus 10,000, means the investor is borrowed, for example, from bank or from some of his friend at the time 0. So at time 1, the investors has to pay the debt to the bank or his friends at some rate. So what is the value? That value becomes 1 plus R into 10,000. So it may be borrow. If it is borrowing, that means what I am telling you. Suppose this is my portfolio. Suppose my portfolio consider of 10 things. First thing is this. First X1 and others are what? X2, X3, X4 and like this up to X10. So X2, X3, X4, these X10 are the investment in shares. But what is X1? X1 is my borrowing amount from the bank, by which this money what I'm funded. So if it is this, I'm consider this expression, that is, suppose an investor is allowed to borrow some amount of assets from some broker or this kind of things, that is known as short selling. So you just allowed to borrow some assets from some of your friends or brokers at some prevailing prices, and the later date asset must be returned. This may lead to either gains or losses depending on the situation of the market. So this is called short selling. So it is surely a risky operation. And the third one is the case of contract. What is the case of contract? Suppose asset I is given by a contract. So one who writes the contract, I, suppose asset I is contracted, and that the contract is constructed on the asset I. So the one who writes contract I at time 0 and sell it in time 0 at some fixed price, suppose P0, but must have to pay at time 1 for some specified amount P1. That is actually happening in case of futures. You may know the situations of futures. That is, futures is happening mainly in case of purchasing oil barrels, and that is today India made a contract with suppose UAE that this amount of this is the price per barrel, and this amount of oils are purchased, and at what rate, that is important. That rate, if suppose it is based on the today's rate. So if it is today's rate, then after suppose the contract is this, that after 3 years India will get the oil. So what will be the price after 3 years? If the price is lower than related to today's price, so India is a loser. Then that case the excise becomes negative. So this is the case of contract. So these are the situations. So do not always think that these excise are always positive. They may be negative. So now another concept. These are the conceptual value things, that is, we have when you proceed with the finance, these kinds of things are there. Suppose at time 0 the investor has invested XI in asset I. So the portfolio you know earlier, that is the X1, X2 and Xn, and wealth you know, that is W0, which is X1 plus X2 plus so on and Xn. And so it is termed as the initial value of the portfolio. So W0 is what? That means this W0, this is the initial value of the portfolio. Now, XI is the investment in asset I. So the number of units of the physical assets I am purchasing by money amount XI is this, that is HI is this. Now, after one time period, suppose after 1 month or 1 day or 1 minute, whatever may be, the price becomes P1 of XI. Suppose of this I asset becomes P1I. So the number of volume of the share, that is quantity of share, turns to this HI becomes this now. That is, this is the final value. So this is the initial value of a particular share in the portfolio, and this H is the final value of a share in the portfolio. These two are not same. Mind this, these two are not same. So we can consider these in terms of how the portfolio values changes. That is this is the initial value of the portfolio. Now what is the final value of the portfolio? My money amount remains same, that is XI, summation of XI, that is I is equal to 1 to n. And if what is the value of XI is now, that is PI into P1 into HI. So if it is P1 into HI, now this HI is what? HI is the number of the shares which I already hold in period purchased during period 0. So that is XI by PI 0. So in place of HI, I put this value, that is XI by PI 0. The things become this, these things becomes this. And if I make some manipulations like this kind of things, that is P1 minus P0 plus P0, that is adjusting by P0 multiplied by XI divided by P0, the things just I break it in terms of two parts, that is P1 minus P0 by P0 into XI. And another part is P0 by P0 into XI, that is only summation of XI. And this part, that is P1 minus P0, is nothing but, we know earlier, that is the return, that is R. So this is the thing. Looks how the wealth changes. This is the initial wealth, and this is the return. These things may be, this part may be positive, sorry. This part is maybe positive or negative, whatever may be. So from here you can construct that W1 minus W0, that is the part. So consequently the difference between terminal and initial value W1 minus W0 will be what? That is summation of Rxi, Rixi. So I think it is clear. So it is very simple. So next one important concept, that is the normalized portfolio. What is normalized portfolio? That is without mentioning that kind of HI, without considering that kind of HI. Suppose that there are n number of assets, the investor has the initial amount of money with W0, and the basic thing is that what proportion of amount of money W0 be distributed over the different n assets. So we consider that we have a portfolio for which these are now the fractions, that is x1 plus x2 plus xn, and these fractions are generated from where? That is what I earlier considered as x1, that x1 by W0, that x2 by W0. This x1 is generated, or you may write it in terms of the h, that is h1 plus h2. So obviously the sum is equals to 1. So if this is the thing, that means earlier I just showing you here, that is earlier x1 plus x2 plus xn is the thing that is equals to W0. And now if I write this by this way, that is this way. So what is W0? W0 is nothing but the sum of the all xi. That means this is like the some probability definitions, that is xi by summation of xi and dot so on, xn by summation of xi. This is equals to 1. So this is the situation of normalized portfolio. Mind it. What is normalized portfolio? Normalized portfolio means if the sum of the all portfolios is always equals to 1. So what is the return in terms of the normalized portfolio? Any kind of return is estimated by this one, that is what is the final value of the portfolio minus initial value of portfolio divided by the initial. So we get earlier that W1 minus W0 is nothing but summation of Rixi. Just we derive this, that is this one. So this divided by summation of summation of xi. Now look, I can write it by this way, that is this Ri, and if I introduce this summation within this summation, I write this in terms of this shares, that is a particular any individuals things, and we may write it as small wi. These are fractions, so small wi. So look, this is the situation in case of any kind of portfolio other than not normalized, but which is normalized. In that case, this summation is always equals to 1. So this is the difference between normalized portfolio return, that is in case of normalized portfolio it is only Ri into xi, but in case of non-normalized, that is the portfolio which is not normalized, that case this thing is given by this form, that is Ri into this. So this is the story of normalized portfolio. Next one is already I'm telling you, that is what is self-financing. That is self-financing means what? That is summation of xi is equal to 0. That means this, I'm telling you earlier, that is suppose I have 10 shares, and first suppose I have 10 assets. First asset is what? First asset is my borrowing amount from the bank, and other 9 assets are the different amount of by that money I purchased all other 9 shares. So all the sum is equals to 0. This is the possibility. This possibility is known as self-financing. That is, how can this portfolio created? Suppose an investor can borrow some amount of money from a bank. By that money, he buys some positive amount of all other assets, and the portfolio is like this. And the first position, that is the x1, is identified as a bank account, and that position is negative. Other positions like x2, x3, dot so on, xn be positive, because those are financed from that x1. So summation of xi is equal to 0. So clearly, the buyer will go for short selling. This is called short selling for making the return positive. This kind of things will happen when the share market is at some boom of this kind of situation. People always liquid his all other assets and find out the money and trying to invest it in case of this. So if this is the thing, look, what is important. If this is the thing, that summation of xi is equal to 0, that is the self-financing return, then in case of the self-financing return, the portfolio return concept is not valid because this is 0, so the concept becomes undefined. Something divided by 0, that means undefined. So for self-financing portfolio, it is not a valid concept to find out the return. Mind it. What is valid? The valid is you just get the difference between W1 and W0. That you have to that is actually you have to find out the W1, because W0 is 0. So W1 minus W0, you get the W1 minus W0, but W0 is 0. That is actually equals to W1. So in case of self-financing portfolio, the return you may write the return in terms of only W1. So now we are going to the how to consider this portfolio return. So this is the thing, that is, suppose an investment rupees V in two assets. Assets are A and B, and XA denotes the fraction of share of wealth invested in asset A, and XB denotes same thing for the asset B. So the rupee amount invested in A is what? A is V into XA, and because this is the in total investment, and V into XB. So if it is considered in this form, that is V into XA plus V into XB, the investment share added to 1. So you may write XA plus XB is equal to 1. So what is my portfolio? My portfolio is XA and XB. This is my portfolio. Suppose this, that is 50% of my V is invested in A share, and 50% is invested in B share. Then my portfolio is 0.5. If it is 0 and 1, then the whole wealth is invested in B instead of A. So these kind of things. So now suppose RA and RB are denote the return of one period for the two assets, and we wish to determine the simple one period return by the portfolio defined by this XA and XB. So what will be the value? Simply we know the value of A becomes what? Value of A becomes V multiplied by this, that is X into 1 plus RA, and the value of B becomes V multiplied by this. So what will be the return of the portfolio at the end of the period T? That is V into this. This is the total return, and you may consider this term, that is RA XA into 1 plus RA plus XB into 1 plus RB as the gross return on the portfolio. So the portfolio gross return is what? That is the weighted average of the gross returns of the two assets. If I consider here two assets, so we just identify the gross return as 1 plus RPT. That is, RP stands for portfolio, and that is equals to these two. This one plus this one. So if I break these two, I get these results. Just look. And where XA and XB is always equals to 1 from the previous one, that is 50%, 50%, or 0, 1, or 1, 0, anything, 80%, 20%, this kind of thing. So this is always equals to 1, and this part is there. So ultimately the things becomes this. So what is portfolio return? That is just XA into RAT plus XB into RBT. So it is equals to the weighted average of the simple return. It is just the weighted average of the simple return. I'm just giving you one example. Consider the portfolio of Microsoft and Starbucks. They are the two companies, and which are initially suppose you purchase 10 shares of each stock at the end of the month T minus 1. And what is the price of the Microsoft? This is price of the Microsoft is 85, and price of the Starbucks is 30. And what is since you get the 10 shares, so what is the VT minus 1? That is this. That is 10 into 85 plus 10 into 30. That is, you just get 1150. So what is XMFT? That is 850. This 850 divided by 1150, that is 0.7391. And what is the same for the Starbucks? So at the end of the month T, that means one period, just you get the prices of the Microsoft and Starbucks are like this, 90 and 28. So what is the return? Just you estimate earlier, that is like before, that is 90 minus 85 by 85, that is 5.88% return in case of Microsoft, and in case of Starbucks, it is loss, that is minus 6.67%. So in terms of the portfolio, in terms of the 1 month return, in terms of the portfolio, my return is this. That is this return into that value, that is the value per share, that is 73.7391% amount is that is invested in case of Microsoft, and 0.2609 is invested in case of Starbucks. That is XXB actually. So we just multiply these two and we get that overall portfolio gives us a return of 2.609. So the value of, we consider this is the return, and what is the value of my rupees 10? That is what I suppose 10 shares are not rupees 10. What is the return of 10 shares gives us? That is VT minus 1 into this. That is what is my initial value, that is 1150. It is estimated earlier. This amount, this 1150, that is VT minus 1. And what is the value of VT? This becomes this into that 1.2609, that becomes 1180. So only 30 rupees gain I find out. So how to solve the problem with the help of R, that is price of Microsoft at this. So we consider this. And the Starbucks, and the initial value. And what is the X for Microsoft and Starbucks? So return for Microsoft. Same thing for then I combine this two. Then I estimate the portfolio return. That is 2.60. That is my ultimate portfolio return. That is we estimate here. This one, 2.609. But now, what is the value of the wealth becomes? And there is 1180. So these are doing without any packages or these kind of things in case of R. So so if there is dividends, this is very simple. That is between PT and PT minus 1, there is some dividends of PT. So we can write this by this expression. That is what is my return. That is PT plus DT plus PT minus 1 by this. And by rearranging this, we can write this by this form. So you just find that is this is the term earlier we get. So whatever may be, that is this value, that is PT by PT minus 1 by PT minus 1, or you may write this as PT by PT plus DT by PT minus 1. That is this is equals to 1, and then you get the similar 1 plus RT2 is equal to this. Again, for the 2 periods, if there are 2 periods gap, we write this by this way, and if we can break this, that is PT by DT by PT minus 2, and this can be written. 1 minute, my mouse is disturbing. Okay, that can be written by this way, that is Pt plus dt by Pt minus 1 into Pt minus 1 Pt, and this is okay. So this term, that is Pt by Pt minus 1, is written in this way, that is 1 plus Rt minus 1 and so on. By this way you can estimate it for many times. So now adjustment for inflation, for return calculation, it is important for us. That is whether we are on nominal price or current price of assets. So returns computed from the nominal prices, a nominal return, real return of an assets can be considered over a particular horizon, taking into account the growth rate of the general price level. So if the nominal price of the asset grows faster than the general price level, then the nominal return will be greater than the inflation rate, and the rate of return will be positive. So conversely, if the nominal price of the asset increases less, then that will be negative. So computations of real return of an asset is a two-step process. First one is deflate the nominal price of the asset by the general price level, and then like other theories we were what we are doing in case of adjusting the price levels. So compute returns in the usual way by deflated price. So to illustrate this, we consider real simple one period return, that is Pt denotes the nominal price and the asset in time t, and CPI is the general price level, that is consumer price index at time t1 at that time. So it is deflated. So when it is deflated, we get that is real price, that is Pt by CPIT, and the real return is what? That is real return is Pt real by Pt minus 1 real by Pt minus 1 real. And what is Pt minus 1 real? That is in terms of the above form, that is Pt by CPIT and Pt minus 1 by CPIT, and divided by this, and we get this form, that is this thing. So if I transfer this one, that means adjusting with the inflation rate, nothing but this. So if I transferring this one, this relation becomes this. And look here, the inflation is estimated by this one, that is CPI between t and t minus 1, and that CPI, just making the divisions, that is CPIT by CPIT minus 1, we get this is 1 plus pi t. And so look the relation, this relation. This one, this Pt by Pt minus 1 is written in the form 1 plus Rt, we know earlier derived this. And this form, that is CPIT divided by, if I bring this term in the denominator of the denominator term, that is CPIT, then that becomes 1 plus 5t. So this is the thing. For example, suppose the CPI is 1, that is 1%, that is consumer price index is going by this way, and then this that is 1% monthly growing rate. So real price of Microsoft is 85 by 1, that is 85, and that is real price after one period it becomes 90. So 90 by it becomes 1.01, that is 89 point this. So what is the real return? That is this. So you can adjusting the inflation also. Either you calculate that is 4.83% your gain real return, and otherwise you can estimate these things over the inflation, considering that is without considering the inflation. That is this is my gain, that is 5.88%, and what is the inflation rate? That is 1%. So you can estimate by this way. That is also gives you this. So this is the way, that is how to adjusting these things we have to consider during the calculation, during the estimations of the return. So in case of continuously compound, these things are like same. When the things are continuously compounded, that is we can write, that is 1 plus Rt is what? E to the power Rt. So we may write Rt is equal to this log of 1 plus Rt, and what is 1 plus Rt? That is Pt by Pt minus 1. So it is log of Pt minus 1. So from this relation, you can find out that transferring the log, this is an exponential relation, that is e to the power Rt is 1 plus Rt. 1 plus Rt or Pt by Pt minus 1, or you may write here Pt is equal to this kind of relation, Pt is equal to e to the power Rt if it is continuously compound. Or otherwise you may write Rt is equal to that log of Pt by log minus log of Pt minus 1. So for example, what is the difference? You just consider, that is if Pt minus 1 is 85 and Pt is 90, then the thing is, that is 5.88%. And if I take the log of this value, that becomes log of 1.508, 1.0588, that is 5.71. And if I take the estimation of the same RT by taking, that is log of 90 minus log of 85, and that is this value, that is 5.7. So the either you go by this way, or you can go by this one also. So whatever may be, either you consider that 1 plus RT is equal to ET by RT, or you may consider PT by PT minus 1, its log is equal to RT. So you may follow any one. So since the form is given there, so if I consider the continuously compound case with R, the result is this same thing, because the data is already there. So it is given by 5.71. If I consider either in terms of the PT relation or in terms of the RT relation, whatever. So this now we go to directly into the sections that how the returns are estimated in case of R. So to do this, basically what we are doing, that is on the basis of some historical data, because you can download also that is the interesting thing, that how to download, because every stock prices or this kind of data we are actually Yahoo Finance, we are downloaded from Yahoo Finance. These data are also downloaded from Yahoo Finance. That is another task. So we discussed the calculation of returns from historical prices and through R, and we also display the graphical things, how it display the prices and returns. These things is based on daily adjusted closing prices of Microsoft and Starbucks, and the data is quite bold, that is 93 for January. You may decide it, because if you go to the Yahoo, that is yahoo.com, there you have to choose your date, month, year, this kind of things, from where to where you downloaded. What you downloaded, that is given in the download portion of your computer, and from the download portion you just here in R, one option I just showing you. There is one thing is there, that is import data set. So if it is in Excel or CSV file, you just download. You just click on this, and you put the name of your download file here, and then browse or import anything you press, and it will be downloaded. Okay. So now we are for doing this, what we are dealing with here, that the one package is required for us, that is known as IntroComFina, and that is to deal with the financial data. This package is required. This package is very easy for us. That is, I am showing you how to install. That is, one common language is there, that is install packages. Look, if I type install, what is the beauty of the install packages is there, and there is a two brackets is there, and you just put this notation, and then you write this thing, that is IntroComFina. It is from the CranR projects. So I put this here, and package is installing. Look, here is some red symbol is there, that is the package is installed. It is installing. Okay, it's. So when you install on packages, then you first go to the library. It is the rule of R. That is, if you go to the library, it becomes open. So you just open the library. Otherwise, your data is not opened. Otherwise, your package involves some data, and the data are not opened. When you put this thing, that is library coding, that is library info Comfina, then the data becomes open. So for calculations and drawing, we required another two packages, that is XTS and Zoom. These are automatically in my software, in my computer, sorry. And It is already there, so it is not showing, but when you are put the library X, there are something will come. So I open the methods in the data, that is Microsoft daily prices and SUBX daily, Starbucks daily prices. Then making the stratum of the data. Look, the data are here. Don't go through everything. The data are here. These are the data. Don't arranging way, that is R is not identified. R is not identified the data. They are only, it is only a visible. It makes you visible how the data are there in different things are there. And with different things, the data are there. That is the Microsoft daily prices 1.89, 1.92, 1.98, 1.94. These are the prices. And see, these are all in dollars. So I convert, one interesting thing, how I convert, because my interest, suppose, is to making the concern of monthly prices. So I convert this data set in some monthly database. So monthly MSFT, monthly Microsoft monthly prices. And then SUBX also. And then make the stratum of monthly prices. Earlier one is the daily prices. So these are the monthly facts. Now again, it is like before, these are the monthly facts. So I confirm the date, that is started from 3rd of January 2014 to say 1st of July 2014. These 3 dates data I want to see how they are. That is 1st January, that is 3rd January, 1st March, 1st June, and 1st July. Then Microsoft's values are like this: 35.67, 34.92, and 35.91. So I consider this for the 1st March. These are the data, and these things are you can see anyone by choosing the dates here. So same thing for monthly data. These are for the daily prices. So it is January, February, March 2014. The Microsoft values are this. These are the monthly data. So the data is now transferred from daily database to monthly database. So we are confirmed about this in our. So if I am merging these two data, so merging these two data, that is 1993, January, February, March, like this. These are the prices of Microsoft. First row, first column is the price of the Microsoft. Second column is the price of Starbucks. Now I'm going to plot. So these are the things. So these are the outputs. And this is, you may expand this here, how it looks like. So this is the advantages, and you can copy this or paste it in your Word, Excel, or this kind of things. So this is the beauty. The diagram is very nice. Okay. So next, this is, I want to show in different panels because these two are in the same panel. So it is multi-panel. So these are the data set of one is Microsoft is in the black and the Starbucks in the red. And what Jew is helping, what Jew is doing, that is without making any graphical display, what kind of, suppose we are interested in some specific portion, that is we can change the graph as per our interest portion. So we can make the things by applying Jew. So now we make the grid. So here they find the grid is prepared, and then we fix the legend. So black one is the Microsoft and the red one is the SUBX, and this plotting is already done. Okay. Again, separately you can do this. So these are the things. And what is the beauty of the art? Those who are familiar, you know the back, all back things are here from where we started. So all everything is started when you start from the initial. Okay. So we just going to calculate the return now. That is simply monthly return, that is these things, and from historical prices with the help of XTS and SUBX monthly prices first we consider. So you consider the return calculation. So look, since the initial period is January 1993, so its value is not there, it is not any, and the February, March from where you get the return. These are monthly derived from the SUBX monthly. So if I remove the January data, if I remove the January, because it is meaningless to us. That is 1993. That is monthly prices of SUBX, and this thing is actually happening because when we are dealing with the data in econometrics, there are so much data are not remains there. That means they are actually not appeared. Suppose on some primary database, you do not get a response of a particular questions from individuals. Then that is the omitting variable. So you have to omitting. This is the code for the omitting. That is head any omit. So we omit the January, and the things becomes this. That is January is not there, and the difference function. The difference function is compute the first difference in prices, and the lag within the bracket function computes the lag price between. So look, we consider all the July up to July, the values are like this, and on the basis of some simple annual rate. That is, these are the return. And now if you try to estimate this in terms of the compound return, you can do this also. Continuously compound, simple compound, and this is the results of simple compound. And if you try to do this for continuous compound, the values are like this. That is for the thing, and then that is you take the difference of like this SUBX monthly return is equal to if log SUBX. Monthly prices. So there are something is missing. Okay, so we can estimate this by estimating the values, that is 1993 January, February, March. Okay, so now there is you get the things, that is basically we are dealing with some random variable. That is the random variable is what, that is you have some probability. Suppose I am considering one example like this, that is return from Microsoft stock during 6 economic conditions like depression, recession, normal, mild boom, and major boom. So X denote the annual return of the Microsoft stock over the next year. And we might that is, make the hypothesis that the annual return will be influenced by the general state of the economy. So these are the state of the economy. These are the state of the economy, that is depression, recessions, normal, mild boom, and major boom. And there is 5 possible states. And a stock might forecast different values of return for each possible state. So X denote the discrete random variable, and for 5 different values. And the table 1 is the probability distribution, you know. And how to estimate this one? That is, these are the values. These are the values. That is what we consider here. That is, these are the sample space 0.30. These are the return from some Microsoft stock. So I consider the return, and then I consider the probabilities, and then I plot this. Mind this is a discrete example, so obviously it will comes in the form of the discrete diagram, and make some beautification of the diagram. I make some blue dot, and then I create the axis. So these are the discrete values which are showing in terms of the probabilities. The probabilities is measured here, and the returns are measured here. So it follows or arrange the something in terms of the pattern, that is from lowest value to highest value. What the probability distribution looks like, it follows like a normal distributions. Okay, though it is a discrete one. So one important thing is that you know that is that random variable is have some cumulative density distribution function, and that function is identified as capital Fx. And what is alpha? Alpha is actually example the quantiles. So 100% of alpha quantiles of a distribution for X is the value, that is Q alpha. That is the value of Q alpha. That is 100% alpha quantiles. And the distribution function is constructed by this way. That is Fx alpha is equal to the probability of X is less than equals to that, and that is equals to that. For example, 5% quantile. What is the 5% quantile? That is defined by this way. That is the probability of X less than equals to Q 0.05. So the median, for example, if you consider the median, it is a 0.5. This value becomes Q 0.05. 0.5. So this fx is invertible, because why? This CDF, that is a cumulative distribution function, if I make the inverse of this, and then you get the x. So what is q alpha that can be derived from this relation? That is, what is q alpha? If you do not know the q alpha, you only know the alpha. Then what is the mathematical formulation? Because there is a mathematics behind this, I am not going to discuss those mathematics. So what is the form? That is fx inverse alpha, and this function is known as a quantile function, and you know that there is a quantile function. And for example, in case of standard normal distribution, quantiles are defined by what? That is inverse of psi. That is, psi means, you know, that is the area under the normal curve. For example, if I consider 1% quantile, that is this, minus 2.33 from the normal table, it is actually derived. And if it is that is 25%, 2.5% area, that is 1.96, that is actually 95% units. You know, that is the value. And if it is 5%, that is 0.05% means that means 1% area. So that is 1.645, and if it is 1%, that is 1.28% area. So these are very important, because the concept of quantile will come later in our discussion. Now, basic the data sets of the stocks is a time series data. So daily or monthly stock prices or returns are basically the time series. I just ask one question to everyone, whether it is boring to you. Just tell me where you get the interest or you feel boring.
Please respond, participants, please.
Interesting, sir. Very informative, sir.
Informative, I means informative if you do not get the interest, because in a 2.5 hour class, total financial things like Marquis model or constant expected return model, this kind of model, I will come. Those who are because someone I found that Savanti is there, and Savanti is in Vidyasagar, and Savanti probably gave us her students about the information of financial risk. We are starting from the Marquis or this, but those who are dealing in colleges, there is no little scope to discuss the finance. So why I am started with simple kind of problems. This is the aim. Otherwise, it is very easy becomes easy to me, that is to start with Marquis or that expectation. But from where this kind of things comes, that is the important. So why it is quite this kind of things are there. So okay, so monthly stock prices or daily stock prices or the returns basically the time series data, because you are dealing with time series class, and I found your course that is that there is a huge thing on time series. So suppose consider a stock price, and that stock price is started from where? From which date? That is the date when the company enlisted his stocks, and from that date you get the prices. Suppose it is 20 years, every second data is there. That means huge data set. That data set is identified as this symbol. That RT means that data set. That is, it is a univariate, particular one share you consider. And that data is what? The data looks like this pattern, suppose. This is the pattern. That is 15 plus some white noise. 15 plus some white noise. That means data. That means in a diagram, if I draw a line making y15, that is parallel to x-axis, the data are in both sides of that line, very close. So these kind of things are there. So we know that is this RT, this in case of time series data, this is a basic feature of the time series, that the data set is a covariant stationary and ergodic. That means this epsilon t is obviously follows the covariant stationary and ergodic stochastic process. So what is the meaning of the, I think it is discussed in time series, that is its mean is constant, variance is constant, covariance is difference of the lag, depends on the difference of the lag, but not on the time, and the correlation also that. So we define that is covariance, stationary, and ergodic. And we take a sample from that data, and that data is this one, that is starting from 1 to capital T. And the data are like this, that is R1 is capital R1, some part of, that is representation of the sample, population, representation of the population in the sample. So what is my data? I started with the data that is daily and monthly adjusted closing prices of Microsoft stock and Standard and Poor 500 index. You know the Standard and Poor, that is the like it is in our country. It is Nifty. Nifty means 50 companies, that is the most dependable 50 companies share prices, average of that. So in US, it is called S&P 500, that is Standard and Poor 500, best 500 companies. This means they are dependable, not higher prices always. So my period is from 1998 to 2012, and that is also, these are also there. That is install packages, then library. This is done. So I first install XTS. It is already there, so it will show something. Yes. So then library XTS. Then install packages June. Then library Jew is there. These are actually done earlier. Same thing. These are the daily prices. It is already there, so it is showing something wrong. But for you, for the first time, I am mentioning this thing. I take a sample. Now this is new. Now I take a sample. That means some restriction over the data. That is daily prices of Microsoft sample, because otherwise the total data will appear. And the Standard and Poor 500. Then monthly prices. Then I combine these two. In terms of daily prices and also in terms of monthly prices. Then the new thing is new package is required for the analysis of the performance, that is the performance analytics. And it is also there in my computer, but those you are applying it new. So here you just make another command, that is install performance analytics, this kind of things. And then make the library open. Then I estimate the return. both, that is monthly and daily prices of Microsoft over my sample. And similarly, SP500 monthly and daily prices. You treat SP500 as a different kind of share. Don't make things complex. Just think about it is a company share. Just treat like our Nifty. I'm removing the missing things. If there is any missing informations over the data. This background preparation of R is tough. This is the bad thing with R. That is, you have to prepare the estimation technique. Then now my R software becomes ready to estimate the things. Then I first go to the time plots. So what is time plots? That is the graphical descriptive of statistic, and this is simply a line plot with the time series data on the y-axis, and the data are on the y-axis and the time index on the x-axis. And time plots will quickly visualizing the things. Here we are going to plot the two-panel plot that is showing the monthly prices of Microsoft and SP500. So we are doing by Jew objects, that is these things, that is plot Jew. That becomes visible SP500, and but look, the axes are not earmarked, so you have to mark in the axis. And then the AB line is fitted, and then we plot the so look, that is plotting of Microsoft and SP500 separately observes in a diagram over the concern 1998 to 2012. The prices exhibit something random walk behavior, that is no tendency to revert to a time independent mean and appear to be non-stationary. So the data set is a non-stationary, and both the prices are shows two large boom bust periods like this kind of things associated with dot-com period of the late 90s. Look, it is here in this things like late 90s, both the shares are there is something more inconsistent, and these are consistent. This part is consistent. That share is keeping consistent, and again it becomes inconsistent after 2008. The data set becomes inconsistent. So a strong common trend behavior of the two prices, and here you can find that. Look, here is a trend behavior. Here is a trend behavior. Look, from in SP500 it is not observed, but here observe it is here. Here is a trend behavior. Here is a trend behavior. Here is a trend behavior. So it is a trend behavior. So you remove the trend behavior, and the figure after elimination of the trend horizontal line at 0, each panel is created by using the function like this one, that is my.panel. My.panel gives us the idea, that is how to create using the custom panel. So to contrast to prices, return shows a clear mean reverting behavior, and a common monthly mean values looks very close to 0. That means these values are very close to 0. This is the mean value. Everywhere it is mean value. But look, the time axis, that is the value axis, is different. It is minus 0.2, it is plus 0.2, but it is here minus 0.05 plus 0.5. So observing this two, we cannot say that which one is better to purchase. That is, if you are considering over this over the future projection. So there is a that means there is a volatility. That is volatility is there. So coincidence of high and low volatility periods across. For example, series shows higher volatility over the periods 1998 to 2003. There is higher volatility, and 2008 to 2012, and over the period 2003 to 2008, it is quite lower. So possibly there is some non-stationarity, and the coincidence of this high and low volatility suggests that the time varying behavior, and it does not appear in visual evidence of systematic time dependence. So we have to estimate the autocorrelations, whether it is very close to 0, and on the basis of this, we can comment on the stationarity. So suppose we are going to in this R panel, we are going to make the volatility more clear. That is, y-axis scale for Microsoft is much larger than the scale for SP500, because it is minus 0.2 to plus 0.2. Look this, and it is 0.0 minus 0.05 to plus 0.5. So to compare the volatility, you have to plot the returns in the same graph. And this can be done by this one. That means you have to make the change of the axis into the same thing. Look, both are plotted over the same diagram, and which one is what? That you have to identify. You identify first the axis, that is the AB line. So with 0, 0, this is the AB line like earlier, and legendary. Let me confirm the legend. So red one is the Microsoft, and blue one is the SP500. So higher volatility of Microsoft returns, especially before 2003, is clearly visible. However, after 2008, the volatility of the two series looks quite similar. So in general, lower volatility of SP500 index represents the risk reduction due to holding of a large diversified portfolio. So now we compare a simple and continuously compounded return. So we consider here over these two, that is rate differential between these two. So look, now they are scaling in same time. Now they are scaling in same time. So look, this is the top panel shows the simple return. Only this is for the Microsoft. Top panel shows the simple return, and the middle panel shows the continuously compounded return, and bottom panel shows the difference between simple and continuous compounded. That is, qualitatively, the simple and compounded return look almost identical, but the main difference occurs when the simple returns are large in absolute value. For example, mid 2000s, early 2001, early 2008. This kind of situations we just look. That is early 2001. There is the fluctuations, and there is also 2008. There is a difference between the compound, continuously compound, and the simple compound. So when the simple return are large and positive, the continuous compound return is not so quite large. So if we consider this for the daily returns, just change the variable. Look here, I plot SP500 daily return. So look, compared with the monthly return, the daily returns are closer to zero, and magnitudes of the fluctuations, that is the volatility, is smaller. However, that means if I expand this one, it becomes easier to do this. Okay, look, but the same thing, because more frequency is there, because in case of daily return, more frequencies are there. The clustering of periods of high and low volatility is more pronounced in daily return. And with the daily return, the volatility of the daily return of Microsoft is larger than the SP500. And large and small spikes, these are called spikes in case of time series data. You know, the spikes that represents usually large for daily movements, that is in compared to the monthly movements. So we make some equity curve, that is compare the investment performance of the two assets, that is SP500 and Microsoft. Plot the simple multi-period cumulative return of each asset in the same graph. And this graph is called equity graph. That means when you plot the investment performance of two or more assets in the same diagram, that will bring you the equity curve. That equity curve is actually the product of the returns of the different periods. Earlier we derived. That is 1 plus RT into 1 plus RT minus 1 into 1 plus RT minus 2, and so on. So to do this, we consider the equity curve, that is the formula, and in case of compound interest, that is continuous compound, these things. So to derive the equity graph, these are the equity graphs of Microsoft and SP500, and then make the legendary. And this is the thing that is over between 2000, like here 1999 or 98, and 2012. That this figure, this SP500, more or less more stationary in compared to the Microsoft. So, that is to make the equity curve. You know that this function of R, that is this is CUM prod. This is the main function, that is to consider the equity curve. And the figure shows that 1 rupee investment in Microsoft dominates 1 rupee investment in SP 500. And in particular, rupees 1 invested in Microsoft, it becomes something larger rate, more or less double. So these things are happening. So now I am going to discuss about some descriptive versions, and then we go to the constant expected return. That is if you want to draw the histogram, that is histogram is to understand the normality of the distribution. So this is the monthly returns of Microsoft, and similarly daily returns. And similarly for the SP 500. For daily return of SP 500. So all histograms have a bell-shaped like normal distribution. The histograms of the daily returns are centered around 0, and those for the monthly returns are centered around values slightly larger than 0. So the bulk of daily returns of Microsoft and SP 500 are between look -5% to +5% and -3% to +3%, and the -3% to +3%. So the histogram for SP 500 monthly return is slightly skewed towards left due to more or large negative returns than large positive returns, whereas the histogram for the other returns are normally symmetric. So when comparing two or more returns, it is useful to use the same beans, because beans are not same here. You just find out that is here it is 0, and then it is 0.1, then it is this, and here it is 0, 0, then it is 0.5. So the beans are not same. Look here. So to do this, you have to make the bean same. So for this, because whether the distribution is not normal or this kind of things, histogram is the best way to understand. Some traditional techniques like that is kurtosis is greater than 3. These can also be done by R very easily. So these are making the things in more or less same beans. That is difference is same. Now we make the things, that is what are the returns shape, and comparing by the same way. That is how the things are going on. So you can go, for example, for just 1 minute. You can do everything like quintile calculations and this. That is the value of risk calculations for the QQ plots. These kind of things are there. So box plots, return calculations. So I am not going to this because we are facing some time constraint already 8 and 07 is there, and you are listening these kind of things from so long period. Just I'm going to the one of the QQ plots will be there, box plots will be there, everything, time series auto covariances is there, find out the ACF is there, spree plot, these things. So just what we are interested, because it is a part of the finance, that is, we are dealing with some constant expected return. The first model of asset return is known as constant expected return, and this model is motivated by the stylized facts of monthly asset returns. And it has some assumptions. The assumption is that whether the return is calculated simply or continuously compounded over time, and time is independent and arithmetically normally distributed with constant mean and variance. The model allows the return on different assets to be correlated, but the correlations are constant over time. So this is the beauty of the C here. And it is widely used in finance. For example, risk analysis for assets portfolio, the mean variance portfolio, the CAPM, that is capital asset pricing model, and in other Black-Scholes options pricing, options, and these kind of things. So all these models are very simple and provide important intuitions over the statistical behavior of asset return on prices, and that serves as a benchmark against which more complicated that is then evaluated. So what are the what are the assumptions of the other assumptions, that is this is the, suppose, not considering the prices, we can convert the prices in terms of simpler continuously compounded return over the asset I over some investment horizon between period T-1 and T. So we make the assumptions for the probability distributions of this RIT. That is, what is this? That is the covariance, stationarity, and ergodicity. And that is what the data set is like this. That is what 1 to some capital T periods, the returns are there, and their expected returns is constant. That is assumed as mu I. Variance is, just 1 minute, I will take some water. Variance is sigma I square, and the covariance is constant sigma ij, and we write the covariance and variance assumption in a single by that equation, that is this one. Considering this, I'm not mentioning these two separately, just one, and the correlation is there. And the second assumption is data set is normal. We assume that is the most weakness, significant weakness of the model, that is return is distributed normally, and it is not everywhere you have to change these assumptions when you are dealing with the actual market by considering different Poisson distributions or gamma distribution, this kind of models. Normally these are the follows in case of financial distributions. And the third one is that there is no serial correlation, that is correlation between IT, that is period T, and period S. There is no correlation. That means correlation coefficient of the covariance is 0. And these are normal time series assumptions, and correlations between different assets is also over time, different time is also 0. So these are the CR assumptions, and like before, that is 15 plus epsilon D model. We consider the model is like this, that is RIT is equal to mu I. There is some constant mean value, that is the returns are moving around its mean. That is 15 is the value, and plus some white noise, and that moving around some 15 value. And what is the normal the normality for such Gaussian error? That is Gaussian distribution follows, that is with mean 0 and sigma I square. And then the covariance between them is, this is the assumptions of the covariance of the white noise. And then we find out its expected return. That is expected return of RT. That is what, that is this, that is RT is mu plus this, and since the expectation of UIT is 0, so it is simply mu. So we found that the mean of the return is stationary. And what is the if these things are follows, what is the value of the variance? And you find that the variance is this, that is mu I plus epsilon UIT, that's variance, and it is since this is constant, this is a constant values. because return something 15 like that part that is constant. So its variance is 0. So only the variance of UIT is the variance of RIT. And similarly, the covariance of this is that is sigma ij, and covariance of over the different periods, this is 0 because t is not equal to s, because no correlations between this period return and that period return. And the correlation coefficient is this, that is identified as rho ij. So these are the things. The correlation between the different time periods is also 0. So from this relation, that is, what is the interpretation that see here as a very simple form. This is also called the measurement error form, measurement error model. This model is known as measurement error model. That is RIT is equal to mu I plus UIT. So from here you can define UIT. What is UIT? That is RIT minus mu I. So if RIT minus mu I, if it is UIT is written as RIT minus mu I, and you already derived what is mu I, that is expected value of RIT. So we write this UIT in this form. So that is each asset return to a constant mu I, that is expected return, plus a normally distributed random variable UIT. And this random variable UIT can be interpreted or representing as what? That is unexpected news concerning the value of the asset which arrives between time t minus 1 and time t. So if the news between time t minus, there is news about what? News about companies. Unexpected some news about companies, unexpected news about the economic variables which influences the companies, this kind of things, if it is considered like the share of Microsoft. So the news between time t minus 1 and time t is good, then you find this UIT is greater than equals to 0, and observed return is above the expected value mu I. If it is bad, the reverse is there, and the variance is interpreted is identified. The variance that is this term is identified as the volatility. There is some news arrival is constant over time. The random news variable affecting the asset I, that is UIT, is allowed to correlate it with the random news variables, and it captures the ideas. For example, suppose I am considering an example, that is Microsoft. That is, one is I is suppose Microsoft and J is suppose Apple Computer Store. So one interpretation of news in this context is general news about the computer industry and technology. So good news lead to a positive values of the errors of both. So hence these variables are positively correlated due to some positive reactions of common news component. So the news of an asset J at the time is unrelated to the news of asset I at the time T for all times T not equal to S. For example, this means that the news in Apple in January is not related with the news of the Microsoft in February. So return normally measured by this thing, that is price of T and price of T minus 1 divided by price of T minus 1, or if it is simply compounded or it is continuously compounded, then this is the thing. So this is a discrete measurement. So we if we treat this one is a discrete measurement, and if we treat this in terms of the continuous, we consider this one. So CER model is continuously compounded return and as following the aggregation property, and the random walk model with asset prices, that is look, if I consider this as RTI is equal to this, that means this, and if I consider this log price of period T as small t, and this is also as small p T minus 1, then again earlier we derived RTI is equal to mu I plus UIT. So what is the value of PT minus 1? That is the RTI. So it is also equals to this, and from here we can get that PT is equal to PT minus 1 plus mu I plus UIT. And taking the expectation of these differences, that is, if I take the expectation of this thing, that is expected value of this is nothing but mu I. So what is this? That is the change of the log of prices, that is expected price, that is expected of log of change of log prices is equal to expected thing of return, that is mu I. And PT minus 1, if it is mu I, then we can interpret this, that is this UIT as PT minus 1 minus mu And this PT minus 1 is delta PT, and this mu is identified as expectation of delta PT. So look, this error is nothing but the changes in the log price and expected values of the changes in the log price. So ultimately this thing is true, that is, if you know the P1, if you know the P0, then you know, and you know the mean and the white noise is there, then you get the P1. And similarly, when you get the P1, you can derive the P2 by same process, and that is this is the value, that is P2 is equal to P0 plus 2 mu plus this. And by this way, by this iteration, so you can get the price of the T periods as Pi0 plus T into mu, because mu is expanding. That means, look, if you now find out the expected value, that is the expectation of the PT price, that is log of price changes, if you find this, then you find what? Then you find this is the mean, that is P0 plus TD. That means you find time is there, the model becomes non-stationary. So this is the thing, that is we get the model becomes non-stationary over the period because the mean is thing. So if we consider, this is the interesting part, a simple technique that is on the basis of some simulated data. If it is known as Monte Carlo simulation of the constant expected return model, and of the same data, that is, the thing is this, that is, we consider the because library performance analytics is already there. So we start from here, that is making the Microsoft daily prices. It is showing that same sample like before, what we assume, that is and the return from February and these kind of things are there. Then simulating the observations, and the model is considered here. The model is, we consider the 172, in our sample there are 172 values, and each and every values are distributed. We feed the model like this. It is a Gaussian distribution, white noise, with mean 0 and the variance is 0.1 whole square. That means 10% risk. And the model is like this. If I consider the model as mu is 0.004 plus epsilon t, and then we feed the model, what is the path? Your task in finance, that is observing some data to fit this one, to consider this one by observing the facts. Now this 0.004 is determined by taking the averages or the median values or this kind of plus some error. Then you can simulate this. Then you get the accurate path. And from that path, you have to explain in economic terms. That is a major task. So here you consider the mean is 0.004 and the standard error is this. Standard deviation is this, and the number of observation is 178.2. That is the length of the sample period. And set CD is the function of R. Then you simulate. Then you simulate the return. That is the form. This is the simulation plot and the AB line. And two marginal AB line which are showing the variation between what, that is 0.1, and there is probably from minus 0.1. So these are the variations. That means you have some concepts about the variances of the data set, and that is simulated return data fluctuates normally around, that is 0.004, and the typical size of the fluctuation is approximately 10%. Though simulated return data looks like actual monthly return data on Microsoft. So if I consider this Microsoft, Starbucks, and SP500 simultaneously, that is, if I want to consider these three data, look how my portfolio will construct. So the three data sets are prepared, and we consider 1998 February, March, and April, Microsoft, Starbucks, and SP500. Three returns are estimated. These are the values. Now, that means we are using multivariate model. So we apply the return of these three over the 3 months period. What is the average return? These are the average returns are derived for three different shares, and the mean value. Then we consider the SD, that is the risk. Look, the risk is highest for SBUX, that is Starbucks, and lowest for SP500, and Microsoft in the medium position. That is the most risky assets, and this is the less risky asset. So we find out the covariances. So these are the covariances. That is the covariances in Microsoft and between the Microsoft and Microsoft own, and Microsoft, Starbucks, Microsoft SP500. These are the different covariances. Rather than this covariances, correlation is more significant for us. So look, this is the correlation. That means which two are highly correlated. That is you find that SP500 and Microsoft is highly correlated. That is 61% correlation, and 45% correlation between Starbucks and SP500. These kind of things, this kind of statistics we can derive from multivariate type of analysis. So now we are going to estimate the CER model. That is doing the things that is estimations of what the sample these are already done by us probably. So from here, if we started, that means what we are going to do, that is we try to correlate some mean and variance, because mean is the representative of return and variance is the representative of risk. So if you find out some relationship between these two, then for what amount of risk, what will be the return you can estimate. So we want to show that mean variance relationship. That is, in case of multivariate analysis like this, when you consider the three shares, you have to find out the my portfolio mean. These are the mean values of the Microsoft, Starbucks, and S&P 500, and then you can calculate the variance. That is the risk. Then only the standard deviation. Then the covariance matrix. Then the correlation matrix. So these are the things, and we already derived. And that is the actual covariances and actual correlation coefficient of the serial. These are the correlations, and the coefficients individually can be defined. That is between the Microsoft, Starbucks, Microsoft S&P 500, and Starbucks S&P 500. So the next model, that is the Marquis one. That is, suppose this is the situations happen then where expected return is higher and risk is also higher. So that means for a risk averse individual, which portfolio is the portfolio of which assets is becomes to be chosen. Because if the situation is like this, if I consider between the two assets, that is mu1 and mu2 are the expected return of the two assets. Suppose mu1 is greater than mu2, but sigma 1 is greater than sigma 2. So for a risk averse individual, which one is the efficient portfolio? That is the most interesting thing. And I'm directly, because time is already end, so I'm directly going to an example to give you understanding. Suppose my return, my share of the assets is like this, that is W1 is 0, first asset, and W2 is full money is invested in the second asset. Second position is 20%, 80%, this kind of thing. These are the expected return. This column shows the expected return, and these are the risk of the portfolio, that is under different share amount of my wealth, and these are the portfolio variances. That means square of this. This is the square of this. So these things are given to you, and one important thing is given to you. That is this. The correlation coefficient between the two assets is -0.5. So if this is an example, from here, when you consider this W1 and W2 and then mu1, then we can estimate this. That is we can estimate the expected return. What is of the portfolio? That is expected return, the sum of the two. Earlier we derived this, and if we consider the variances by the same form, and that is derived by this one, that is W1 sigma 1 square, W2 sigma 2 square. This is a mathematical calculation, just some things. So one thing is important here, it is rho. That is, so why the rho is important, that is -0.5. So considering this equation, first suppose W1 is 0. So that means this term is 0. So this is 1. And now this W1 is 0, that means this term is 0. And sigma p is what? That is 30. That is 30 square, that is 900. So you can estimate the sigma 2 from here. So by this way, for considering different observations, you get the different values of sigma 1, sigma 2, and similarly, from the expected return, you can get the different values of mu1 and mu2, considering the different values of W1, W2. That is, in which proportion you are putting your money in different assets, and you get the returns. So if I plot these returns, what is the important? If I plot this return, the figure looks like this. I'm sorry, not going to those calculations. Oh, sorry. 1 minute. The figure looks like this. The figure looks like, I just put this combination, the figure looks like this. Now, one thing, don't concentrate on this figure. I just changed now. What is I'm changing? I'm changing this, that this correlation between the asset is -0.5. Now I changes it to -1. The figure looks like this. Again, calculate the things. The figure is transferred towards the upward direction, left upward directions. This. If I changes the correlation to +1, of the same things, all the combinations of changes, then I found the figure looks like this. So that means that this is the relation between what? This relation between sigma p and mu p, because different values of sigma p and mu p is put it there. So if I found this, that is depending on the different values of mu and sigma, what Marquis told us, that is, if rho is 1, we found a linear relationship. That is, correlation is if these are the two different portfolios, and the combinations of the two portfolios will be linear if rho is equal to 1. If it is rho is equal to -1, again it is linear, but it moves towards the left direction. That is in the earlier figure. And if it is rho is equal to 0, it looks like some parabolic form, because the equation is in the form of W1 square and W2 square. So it is not a straight line curve. It is something like a curve form. And if it is from 0 to +0.5, it moves towards this. There is one line, this blue one. And if it is moves towards -1, that is minus 0.05, this bends towards this. So considering these points, this each and every point shows a risk return relationship between the curve, between the portfolios. So look, if you consider this point C portfolio and if you consider the point B portfolio, both have the same risk, but the return in B is greater in compared to C. So always we are interested in this portion of the curve, not in that portion. So if it looks like parabola, surely it will be looks like a parabola because it is a square plus b square plus 2ab type of form. So it is a parabola, and on the parabola you always move into this direction because here you are considering the same risk. We are always moving towards a greater return. So very quick, if it is possible for us like this, just wait 1 or 2 minutes. Suppose this is the value of mu. This is the value of sigma. This is the value of sigma square. Let me squaring the sigma A. And this is another asset. To find out the correlation and find out the covariances, and then I consider the 50% on A share and then remaining 50% in B share. The expected return in this form. Combined sigma is in this form. These are the mathematical formulas, not, and those are plotted in R. Expected mean, that is, if this is the situation, that mean of the first cell is 17.175 and sigma is 25%, and sigma square, sigma is, sorry, second one is 0.05 expected, like the star bar, that is SP500, and it's sigma. Then I combine this with the average mean, that formula, and then find out the combined, that is the portfolio mean. We get the portfolio mean and we get the portfolio variance also. That is 17.51. So look here, the asset for asset A, it is 25% risk, and for asset B, it is what is the sigma? That is 11.5% risk. That is. But here you find the portfolio risk is 17.51%. So what is the SD? So if short selling is allowed there, this kind of things, that means if I returning this kind of things from the other kind of things. So if the investment possibilities are like this, suppose A asset here in the last example I'm concerned, I'm just ended with this one. I will end this with this one. This, suppose the sequence is from -0.4 to +1.4. These are my distributions of the percentage of shares. That is what amount of my wealth I will put in XA and or what remaining will be in XB. So if I consider this, and if xb is this 1 minus xa, because sum of this is a 1 normalized portfolio. So combined risk combined SD, and then we plot. So look, that relations comes. It is a parabolic form. The risk-return relation is always in a parabolic form. That is the invention of Marquis. And if we make the plot more clear by adding the axis of this kind of things, and then adding some points over there for some particular portfolio. This is the situation of asset A. Suppose asset A is here, this green point, and some asset B. So asset B is here. So surely in case of asset B, this is the case of the risk some plunger, and this is the case of the some risk aversion or risk cautious. And this is the most significant point, because this is the optimal point. Why? Because here the risk return relationship is minimum, because otherwise you go there, return is higher, but your risk is also higher. So this is the point. This point gives us the situations like where the risk return relationship is in optimal positions. There is an important concept that is Jensen alpha, or the Sharpe ratio, which will determine your budgets, and that will determine where is the tangency and the indifference between the risk return curve. Because in consumer theory, we know the risk return relationship indifference curve is there as per the individual is risk averse or risk lover. So where he is, there is the situation like incorrect substitution. These are things. So I will end it here, because thank you to give me 14 minutes more, and there is a huge things also in this part, because Marquis part is very interesting one, and the specific risk, this kind of things, because you get this in your general finance book. That is how the things borrowing lending case, that transformation line, that is the Jensen alpha concept. That is I am actually dealing with the availability part, but what is actually doing, that is with the availability, what is the amount of actual things is what happening. That is my choices. I derived the things about my choices, but what are the restrictions over the choice? That is also another part. Those part, this type of concept like Sharpe ratio or Jensen alpha. But I think you started from this initial level. Then it will. I don't know whether it is it gives you some kinds of pleasure of this kind of things. Okay. So if you have any questions of this kind of things, you may ask.